Good evening, everybody, and thank you for joining this fourth edition of our 2025 Insight event, our first online event of the year, and more importantly, our first CEE Insight event ever. So I think that clearly demonstrates the importance and the growth that the region can provide to the EPRA universe. Before I hand over to Mark, I'd just like to say a few words about 2024. You'll recall as we entered the year, the word was cautious optimism. And interestingly, at our Insight event last week in London, we encouraged people to join a word cloud through the app. And over 90% of the respondents said they were cautious, optimistic, or cautiously optimistic. So I think the trend continues into certainly the first quarter or two of 2025. And of course, we all know that there are headwinds, whether it's Trump tariffs, deregulation in the US, or overregulation in Europe, or indeed further wars. But there are reasons to be optimistic. There is substantial dry powder in Europe. The European REIT sector raised over 26 billion euros last year in fresh capital. That was 80% bonds and 20% equity. So there is dry powder, there is optimism. And our priority is clear at EPRA to drive new capital into the sector, whether that's through generalist investors, wealth managers, fixed income, and a particular focus for us this year will be retail investors as well. In fact, in October last year, we published a survey of equity fund managers. Over 80% of those surveyed say they were bullish or very bullish about listed real estate going into 2025. But of course, it's not just about raising new capital, it's about sourcing capital. So we need new IPOs, we need ambition, we need growth from the companies. And I'm sure we'll get some comments about that today. So I encourage you to think big, to think ambitiously for 2025. We know there are headwinds, but there are opportunities. Before I hand over to Mark, 2 dates for your diary. The annual EPRA Finance Summit in conjunction with Bloomberg will be on the 10th of April at the Bloomberg HQ in London. And of course, the EPRA conference from the 16th to the 18th of September in Stockholm, with the main day on the 17th. So thank you very much for your time. Thank you for joining. And I now hand over to Mark to introduce the panel. Thank you.
Thanks, Barney. Greetings, everybody. I'll introduce myself and then quickly each of the 5 panelists, and then hand it over to go around the horn and they can add a few more words about themselves or their company. I'm Mark Abramson, a former global REIT fund manager and partner at Heitman. I'm currently now sitting on the board of a few real estate companies, some publicly traded, some issuers of publicly traded debt that are privately owned. European Science Park Group in Germany, which as the name suggests is an owner of science parks, privately owned, 250 million euros or so worth of assets. On the board of PSP in Switzerland that I think everyone on the call is familiar with. And today I'm wearing the hat, I think, of supervisory board member at a Polish logistics company called DL Investment Group. We have about 1 billion of income generating property, 3/4 of which logistics, and a land bank that is 95% oriented to logistics that'll add a further 800 million of value at completion over the next few years. So to introduce our illustrious panel, today we are joined by 4 corporate executives and 1 buy-side fund manager. So going around the horn very quickly, we have Dennis Salinas, CEO of Globalworth. Globalworth, I think, you'll correct me, each of you, if I get these numbers wrong, but based on last accounts I've seen, Globalworth has about 3 billion of total assets focused on offices, market cap about 700 million euros. The portfolio is about half-half, maybe slightly tilted to Poland and versus Romania. And then we've got Rudiger Dany, CEO of Nepi Rockcastle, slightly larger in size, total assets, I think, of 8 billion euros, focused on retail. Current equity market cap's about 5 billion euros. concentration in Poland, I think 40% of the portfolio, followed by Romania, and then a number of other Central European countries as well. We have Richard Wilkinson, CFO of CTP, joining us. Total assets of 17 billion euros, logistics and industrial primarily, with a total equity market cap of 7 billion, almost half of which I think is in the Czech Republic. Then the next largest concentration, about 15% in Romania, and further exposure to Poland, Hungary, and other Central European countries. And finally, on the corporate side, David Greenbaum, CEO of CPI Property Group, with 22 billion of total assets across just about all types of asset classes, and a total equity market cap of 7 billion euros, roughly the same as CTP, with, I think, concentrations of 28% in Czech Republic, 13% in Poland, followed by Romania, Hungary, and others. And from the buy side, joining us, Mike King, analyst at Cohen & Steers. And just to add some numbers on Cohen & Steers, I think we all know they're the behemoth in the sector, $92 billion, I think, of AUM. I saw on your website, Mike. Equity market cap, publicly traded New York Stock Exchange, $4 billion. So those are the numbers for all our panelists here so far. What I think we agreed to do is try to divide the discussion up into just three parts. First, to talk about the macro outlook and the fundamentals of the various property sectors that we're all involved in. Then a section on capital markets, which is obviously where rubber meets the road. And then the third block of time set aside for Q&A from the audience. So before setting up the macro discussion, I figure I'll go around the panel, as I said, and ask each of our panelists to add a few words about themselves or their company that they'd like to say. And I'll start on my screen. I have you at the top, Rudiger, so over to you, Rudiger.
Yeah, thank you so much. So welcome everybody, and thanks for having me on the panel. So I'm Rudy, heading actually NEPRA Rockcastle, and as you said, we are more or less a pure retail real estate company that is operating currently in 8 different jurisdictions in Central Eastern Europe. And fortunately, let's say, since we came out of COVID and we had a very strong rebound here with tenants coming back into shopping centers, we saw a really great start back, and we are far above the numbers of 2019. So business has completely recovered, and even more, we've been able to grow the business over the last 2-3 years. And I think very much for the favor of our investors, looking at how we are trading now with our share price on NAV and also our distributable earnings per share. I think our investors are pretty happy. We would love to have more of them actually coming from UK, US. Predominantly, our shareholders are coming from South Africa. And especially last year has been for us quite important, as we have been able to raise on the capital markets additional equity, 300 million euros, another 500 million on a green bond, and we're able to immediately actually execute and acquire additional assets. So for us, actually, the momentum in the market is quite positive, and I do understand that there's caution in the market, but we see this especially for Central Eastern Europe, looking at the fundamentals that you want to talk about. We see this with more optimism, at least for the next 12-24 months, as maybe some other participants in the market, which also relates to the fact that, especially within the retail real estate sector, a lot of these retailers coming from Europe, coming from Western Europe, are now expanding within our region. So for us, it's actually a quite positive momentum in the market. Thank you.
Thanks, Rudy. So next on my screen, if I'm going clockwise, Dennis Globalworth, please say a few words.
Thank you, Mark. Thanks, everyone, and thanks for joining. My name is Dennis Salinas. I'm the CEO of Globalworth, an office landlord with assets in Poland and Romania. Offices, of course, we face the challenges you'd expect for office landlords. We had some tailwinds with indexation, offsetting some of the devaluations over the last couple of years. We also managed to deal with our maturities, of March 25 and July 26 through a bond exchange, which placed our capital structure to a strong footing with below 40% LTVs. Overall, we're cautiously optimistic for offices And that is, of course, on the back of restricted supply and improving funding costs.
Thanks, Dennis. Richard, please.
Sure. Hi, everyone. Thank you for joining. Yeah, very happy that EPRA is finally acknowledging Central Europe as the fastest growing business smart part of Europe. Happy that we have the opportunity to talk about that. As a company that's been active in Central Europe for the last 27 years, growing 10% plus a year every year for basically all of those years, and with the potential to continue to do that, gives you a very different perspective on the world than maybe I'm in London today, pretty depressed climate. In London, the further north to further west you are at the moment, maybe a little more depressed you are. If you're an investor, go to the places where the growth is, and the growth is in Central Europe.
Thanks, Richard. David, over to you.
Okay. Hello, everyone. I'm David Greenbaum. I'm the CEO of CPI Property Group. I actually have been selling the CEE real estate story for the better part of the last 10, 11 years. I was originally at Deutsche Bank, where I helped originate many of the first bonds that were issued by Central and Eastern European real estate companies. So I'm very familiar with investors who don't necessarily understand the region and really need to understand what makes CEE real estate in particular very unique. You highlighted in your introduction that we have a very diversified portfolio. I think that gives us a very unique read across various sectors. I think the other three gentlemen on the panel are really, the companies are more specialized in one sector or another. We're invested in just about every segment of real estate around CEE, except logistics, which is not our area of expertise, but certainly, we have some parts of our portfolio that are performing really well, like in retail, as Rudy described. We have our challenges in office, kind of like Dennis described. So, I would say in general, we really do believe that conditions will be better in 2025 than they have been the last couple of years, because frankly, how could it get much worse than it was the last couple of years? So I think we feel pretty good, but I'm looking forward to participating today and trying to give you some interesting ideas.
Thank you, David. Mike, in cleanup. Go ahead, Mike.
Yeah, thanks, Mark. Well, as you said in the intro, I mean, yes, I'm an analyst at Cohen & Steers. I've been here just over 10 years. As you say, AUM globally around 92 billion. Europe, unfortunately, a small part of that. But of course, as the point was made, we always wanted to grow the European sector, and I think. As we will discuss, I think, and has been said, the CEE market is kind of probably one of the best growth regions. But I think for us, and as we will talk about, it's of course very difficult as a listed investor to get exposure. And of course, we can discuss the reasons and what can be done about that. It's a region we like, and we hope to kind of grow that from a listed perspective.
Thanks, Mike. So to frame what's already been said about the growth outlook, I'm just going to read out a few numbers from the European Commission, their latest forecast for GDP growth by country for 2025 and 2026, to really underscore the point of how much more superior the growth outlook is in Central and Eastern Europe versus old Europe, I think it's sometimes referred to Western Europe. According to the European Commission, GDP growth in 2025 and 2026 in Poland is expected at 3% and 3.6%, Hungary at 1.8% and 3.1%, Czech Republic at 2.4% and 2.7%, Romania at 2.5% and 2.9%, the EU average overall 1.5% and 1.8%, Germany a meager 0.7% for 2025 and 1.3% for 2026, France also very sluggish at 0.8% for 2025 and barely better at 1.4% in 2026. And Sweden has a reasonable profile at 1.8% and 2.6%. Those mark, Sweden being called out just because there's so much public equity real estate to choose from up there. So the growth outlook in Central and Eastern Europe is double from a GDP perspective for the next couple of years than the rest of quote unquote developed Europe. Not only that, unemployment rates are lower on average. Debt to GDP levels are lower in Central Europe than a lot of Western Europe on average. So question is, for the panelists, and maybe I'll throw it over to you, Richard, but with Germany and Western Europe, particularly Germany though, being as weak as it is, can Central Europe grow at these rates if Germany is in such bad shape? What's driving these growth rates in your view, Richard?
Look, it's not a new news that Central Europe is the fastest growing region in Europe. It's been that for the last 15 years, and it will continue to be for the next 10 plus years. Because if you look at the fundamentals, they're basically a lot better in Central Europe than they are in Western Europe. You have average debt to GDP in Central Europe is 50%. It's over 100% in Western Europe. So tax rates in Central Europe are somewhere between 10 to 25% versus 40 to 50 in Western Europe. So what you have is the reason for the faster growth is just the better cost locations. And in a world of increasing tariffs, increasing trade tension, producing in a region for selling in a region, if you're going to produce in Europe, you're going to produce primarily in Central Europe because it's a better cost location. What you will have in Western Europe, and you have, don't forget, let's not overdo. Yes, Central Europe is the fastest growing region, will continue to be the fastest growing region, a fabulous place to do business. The German economy is the size of the whole of the Central European economies put together, plus the Nordics. Yeah, so Germany has an economy that basically everyone else in Europe would love to have. Yeah, it has size, it has scale, it has stability, and it's probably not going to grow very dynamically, but it's growing, but it's at an extraordinarily high level that pretty much everyone else would love to achieve. So actually the reinvention and the rejuvenation, the reindustrialization, the rethinking of Germany is a massive opportunity for everyone else in Europe. Because as Germany does a bit better, everyone else will do better. Do Central European economies need Germany to grow massively to continue to grow themselves? No, but they don't want it to start to shrink. So that's the way that I would think about that, Mark. But overall, if we look at ourselves, Asian tenants make up 10% of our total portfolio. In the first 9 months of last year, they made up 20% of our tenant mix. Now, they're all manufacturers and they're all basically coming to Central Europe. But some of the very high-tech ones are going to Germany. That's where we also have a business. So high-tech, high-value add will go to Germany. Germany has an unbelievably talented and highly educated workforce. And there will be plenty of opportunities for those people to work very, very productively. It's just going to be in slightly different industries than they did in the past.
Thanks. I mean, any other panelists, feel free to jump in, but I was thinking to hand it over to you, Rudy, as a retail-focused property owner, you see the domestic consumption as the main driver of those superior GDP growth rates, or what is the main driver for you?
Yeah, I mean, that's very different than in Western Europe. And Richard, I'm fully with you. It definitely has to do also with the factor, of course, that this region can just produce much cheaper and is more attractive for investors on production. But at the same time, from my perspective, looking more into the retail market is it's a total different sentiment and feeling of people. They are still hungry to grow. When you go to Germany, it's a very wealthy country and it's all about protecting your wealth. It's not about anymore of creating your wealth. It's handed over from generation to generation. So what I mean with this is when you are working in our countries, you will see also with your employees that they are still very eager to create this wealth, to have the ability to go maybe 2 times a year on vacation and drive a proper car and have a nice apartment. So I think that is a different attitude. And when you look at it, when I've been in Poland like 10, 15 years ago, I mean, that's approximately where we're currently still in Romania. And we will see this over the next 10 years in Romania, that they want to catch up. And also the resilience to crisis. You saw it now with the inflation, when inflation was hitting the markets. And in Germany, like people would say like, okay, my money's less worth. I really need to keep it on my bank account in order to pay the rent or whatever in the future. While when you're in Central Eastern Europe, people are more used to crisis and they have seen this before, and they were not so, they would rather say, okay, money's less worth tomorrow, let's spend it today. So it's also a different mentality in many ways. And that's why I believe also that is an underlying trend that we see, is that we also saw obviously here that in these countries, salaries have been picking up with inflation. So it was actually quite a good match of these two. So we were not suffering of less purchasing power. But what I want to say is these countries will see growth over the next couple of years. And it doesn't matter whether, I'm fully with you. Of course, there are dependencies, but I don't think that the dependency, especially on the German industry, on the German economy, is as high maybe as it was in the past. And this comparison, I really like to look a little bit into old Europe, where you see that politically much more stressed countries like Germany. It's not only economically, it's also politically, that we see now that the German parliament is coming together again, and we have very soon elections in Germany. We see France also politically, I think, pretty much of a mess. And all these old countries are actually stagnating also with their economies. And it's not only Central Eastern Europe, also when you look at those countries that were under the umbrella actually a couple of years ago, like Spain or like even Greece or Ireland, and how they are performing currently, and as well outperforming the old countries of Europe. So because they have been already through reforms, I think we will see this also in Central Eastern Europe, that this growth story will continue. And from our perspective, we have also proof of this, as you are saying, with your clients, let's say, coming from Asia. What we're seeing is that retailers, they really need to have, let's say, a really good feeling for where do we create our growth, and they are stagnating, obviously, or even going backwards in the old part of Europe. And what is happening now is that a lot of them obviously see that their turnover growth comes from Central Eastern Europe, and we have much higher demand actually by retailers of square meters that we could let as we can. So if we currently have 2% vacancy. I would love to have actually a bit more. Because we could get even better rents. So what I'm saying is the demand here that retailers, especially from Western Europe, have for Central Eastern Europe is just fascinating to see that, because that's where the growth comes from. It's very simple.
I think, I mean, when I think about the year ahead, I think about two risks, and I think one of them Richard has addressed, which is the Germany part. But I think the other question, which I don't think we have an answer for yet, of course, is what will the new US administration do, and what impact tariffs, in what shape or form they come, what impact could they have on the growth that you said at the start, Mark? So that's just something I think about. I guess is we don't necessarily have an answer yet, but that's kind of the two risks I think about.
Dennis, all green lights, or you see some reason for caution anywhere? I think can't hear you, Dennis.
Right, sorry about that, Mark. I think what's interesting is a question that you posed in one of your emails, and that was whether the Central European real estate markets warranted a premium in yield. And does it make sense considering that the macro picture and government financing picture is probably superior to that of many Western countries? And I tend to think of these real estate returns in terms of factors. So we have this macro factor that, as you mentioned, this seems to be superior for CEE. Then we have general property market factor, what I call alpha, which is the alpha in terms of hedge fund speak, the returns of a specific portfolio that has idiosyncratic characteristics and risks, and it either generates positive or negative returns compared to the market. So again, in the macro factor, I think CEE is doing better. In terms of property markets, it could be worse or better depending on the particular supply and demand picture of that particular segment in that particular country, right? So, for example, in Poland, we see that supply is quite flexible, much more so than it would be in major cities or capitals in Germany and Western Europe, because of availability of land. The permitting process is typically much simpler and shorter, and that allows for, when there is above market returns, then their supply becomes a lot more flexible, and that sort of competed away. So from that perspective, you can say there's more risk as an asset owner because supply is much more flexible. Also, you have, I would say, a higher obsolescence risk, in the sense that, like in Warsaw, and David can back me on this one, 15, 20-year buildings are deemed old and they're way more difficult to lease, and tenant incentives become much more expensive. Whereas, what it's like in other capital cities. So again,
it's the same everywhere. 15-year-old office needs to be renovated.
It needs to be renovated, but in Poland, it may not be renovated, or even if it's renovated, it does not compare with it like for like with a new building, right? Whereas in London, for example, okay, this UK, not continental Europe, you don't have that much supply of brand new buildings, right? You're going to be competing with another renovated building in Mayfair or whatever. So I think that is a bit more of a, let's say, risk for specific properties in Central Europe. And it's different, of course, Prague to Warsaw to Bucharest. Bucharest, for example, now has zero supply because there are no permits to be had. So overall, I think there are different factors that would contribute to, let's say, premium yield in this part of the world. But again, as everybody would agree on, is that the macro factors are definitely supportive for investing in CEE. And another observation that we've made over the last couple of years is because there are not so many players that you'd find in Western Europe, the likelihood of somebody being distressed and selling at very significant discounts is quite low compared to, let's say, UK, where you could have an adjustment of like 50-60% of values. So the downside is somewhat protected.
David, over to you. Is it all green lights? Is this a secular trend for the next 5 to 10 years, or just a cyclical?
I was about to answer with something like, "Nah, I'm good." I mean, I think these guys have really kind of covered it. Okay. I think the only thing that maybe we're leaving out, and this is kind of relevant probably for the next segment of the discussion, is just that, hopefully what we'll experience is that the fundamentals that have been, driving the outperformance of CEE economies in the last couple of years will continue in the future, and that maybe the benefit of lower interest rates, because the rest of Western or old Europe, I like that when you said that earlier, old Europe, old Europe, is having problems, therefore rates are trending down. And I think, that could together have a nice impact for CEE real estate owners, the combination of better rates and hopefully continued strong economic fundamentals. I do think there is a risk that tariffs, have a pretty significant impact. You asked, can CEE economies continue to grow with, the Germany being weak and tariffs? I think there is some risk to the growth. On the other hand, the CEE economies are, many of them, less reliant on Germany and less reliant on manufacturing and exports than people might think. And so hopefully we'll see some resilience and a better year ahead. But I don't need to sort of repeat any of the other themes.
Well, and so if we've got a better macro story, we also have 3 of the companies here are among the top 10 or 15 largest in all of Europe, old Europe and new Europe, in terms of assets and market cap. So you have the benefit of scale, which in theory, and well, obviously it's We'll come to it in a second, but in theory, that scale would usually correspond with more liquidity and improved valuation. It's maybe not the case because of particular factors for some of these companies, but great growth story, big size, but is the valuation are the valuation of the capital markets commensurate with? So let's switch it over to discussion about capital markets. I'll just again make a quick observation here. Again, it is, I don't know if the word is ironic or certainly notable that we have Poland is recognized by the S&P family of indices as developed Europe, but FTSE Russell and MSCI do not have Poland in developed Europe. And this is despite the superior macro fundamentals we just spoke about, but also a sovereign credit rating in Poland of A-, which is in line with or superior to Spain and Italy in old Europe. Richard pointed out before we started the call that actually Czech Republic's credit rating is even better. And is it fair that we still think of Central and Eastern Europe, to Dennis's point, as deserving a risk premium because it's somehow still emerging and isn't necessarily, quote, developed, at least from the equity index standpoint? But to kick off the conversation, I also just want to note and start with a question going around the horn. It is interesting that each of these Central European companies is listed on a different stock exchange, and all those stock exchanges are outside Central and Eastern Europe. So we have Global Worth listed on the LSE, NEPI Rockcastle on Johannesburg, CTP on Euronext Amsterdam, CPI in Frankfurt, the General Standard. I guess to go around the horn, if you could talk about what was the purpose, and is the purpose, is the reason for that, for the decision to go public still in place? And can you talk about the choice of listing venue that you selected for your primary listing? So if we could maybe start this time with David, what was the purpose of going public given your small float? Why did you choose Frankfurt General Standard level? And give us some flavor for what is the strategy of being listed going forward?
Sure, I'm happy to cover. I think, you know, our strategy is probably a little different than maybe you think, or that some of the others. Before we get into that, though, I have to say I'm really enjoying your continued use of the phrase "around the horn," and I'm wondering how many listeners actually understand what that means, because it's from baseball. Yeah, it's like a very specific baseball terminology that means go around the field. So I've been really enjoying that. You know, our American phrases have a way of sticking in the mind. For us, we're actually listed. In fact, we kind of inherited the listing. So when CPI Property Group, as it's known today, was formed, it was really formed through the merger of the old CPI AS, which was a Czech company, really the vehicle of our founder, Radovan Vítek. That was merged into a listed company called Orko Germany. And Orko Germany was listed in Frankfurt. Orko was a property company that I think many of my fellow panelists are familiar with, that went bust after the global financial crisis, and we effectively rescued and restructured that company. And that's really why the listing is there. And so it's really very technical, but there's no float in our stock. You quoted our market cap earlier. I couldn't have even told you what our market cap is, because I don't pay attention to the stock at all, because it's effectively 90% owned by our founding shareholder. And we, with, you know, Apollo owning a few percent, there's really no trading at all in the stock. We maintain the listing really for transparency purposes, so that our investors can feel comfortable that we are always being, you know, I think people would see that our disclosure is absolutely the same, if not more detailed than most other European listed companies. But for us, we're a family-owned company. Our founder continues to own and control the shares. We've thought many times about re-IPOing, listing the company, doing things. And those are options that we continue to consider over time. We have a very large investment in a Vienna listed company called Immofinanz. That's quite a great story, and there continues to be a 25% float in that stock. And of course, we've been thinking very openly about strategic options for that company. But again, as a family-owned company, I would say we we prefer to get our financing from the bond markets as much as possible, and our equity from our founder.
Richard, what's the strategy for CTP in the public equity market?
Yeah, well, we did our IPO in March of 2021. For the 20 plus years that before that, we'd been growing organically with the capital that we generated ourselves. So when we listed, we were 6 million square meters of GLA, and capital of around a bit over 2.5 billion euros. Now, and the IPO allowed us to more than double the company since we did it. So we're now 12.6 million square meters at the end of Q3, 1.9 million under construction, and it allowed us to triple the land bank. So we have a really long runway of growth in and around the parks that we own. We doubled the income, doubled the earnings per share, doubled the NTA. So basically, it was an engine for growth, which is what equity should be. Equity should be allowing you to grow a real business. That's what equity markets are there for. They're there to fund growth. So that's what we used it for. And why did we choose Amsterdam? Because Amsterdam actually has the largest liquidity of all of the markets in the EU, and we didn't want to go to the London Stock Exchange because we thought liquidity was going to go down there, which is true, which is what's actually happened. So we think that we're in the right place. And to come back to your question, FTSE Russell, the Czech Republic is not recognized as a developed economy by FTSE Russell because the Czech Republic, the stock exchange in Prague, does not have a liquid equity derivatives market, which in the context of a single securities market in Europe, where we're listed in Holland, is absolutely nonsensical. Yeah, and it is a real problem for EPRA that companies like CTP are not eligible for their developed index because of the idiosyncrasies, and in my point of view, complete idiocy of FTSE Russell.
Let's shift it over to Mike on that point. And how much does the index matter?
It certainly does matter, and I agree with Richard. I mean, we should be doing all we can to grow the index. And you've got some very good companies, which may be listed in Western Europe but have great portfolios in Central Eastern Europe. In my view, we should be looking to grow the sector, growing EPRA. So I think we should be looking at a way to be able to include companies like CTP. I agree, it does not make much sense to exclude them for the reasons that Richard mentioned. But I mean, just generally, we look at EPRA, the EPRA benchmark a lot. And I did some quick numbers back of the envelope. And I mean, a see-through number exposure to CEE is around just under 3%. So it's not, obviously not big. It's not a big part of the benchmark. If we include the companies we see on the screen today, it goes up to around 4-ish%. So it's obviously still not a big part of the investable universe for us. We would like it to be bigger. But we go back to the point David made. I mean, a lot of the companies are very just not investable. Again, I ran a quick search on Bloomberg, looking at real estate companies in 11 countries in the region. I think I got 152 companies. Average free float was around 40%, and the average market cap was free float adjusted was 30 million, which of course for us is very hard to invest in a company with limited free float, limited liquidity. As much as we might like the region, of course, we have to focus a lot on investability and liquidity. And at the moment, that's hard to find. So I would agree with Richard. We should be doing all we can to grow EPRA in the CE region.
And Rudiger, I mean, do people view your stock as South African stock, or are you your Central European stock? And
correctly, the
your
company
views?
was founded with South African money, and therefore we are on the JSE forever. But at the same time, we are also listed on Euronext in Amsterdam. I don't know, but I think especially for us as Central Eastern European companies to create liquidity on Euronext, that's a bit the challenge, at least for us. And it also has to do again with the factor, and I don't know, of course, to be in the EPRA index will help, but it's actually not making the big difference. I think it's the sentiment that still investors, capital markets, especially from UK, have towards Central Eastern Europe, where they still think that these are completely underdeveloped regions where people are, driving carriages. It's like there is a lack, actually, as I believe, of knowledge and also sometimes willingness to accept and to come and to see. It's not just like reading the news, but whenever I do investor tours and I take them throughout the region and they see assets, they are completely astonished, actually, of how developed these countries are already. So to be in an index, of course, it helps. I think now with NEPI, we're joining you guys at EPRA Index this year, first time. But more important is really to, I think, be out there, talk to investors, convince investors by really also taking them into the region, to the markets, and explain, because there is really a lack of, I would say, of understanding and knowledge. Not only, the macroeconomics they can somehow read, but once you go there and you see what is happening there, I think that makes the big difference. And as said, NEPI is the third biggest retail real estate listed company in Europe, and there are still investors out there that, let's say, are restricted here simply because we are Central Eastern Europe. So that's a bit crazy from my perspective, especially looking at the growth story in comparison to peers. So that's interesting. But I think this is just our work we need to do in order to convince investors. And we have just recently done, as you know, a bond raise that's rather, of course, more the easy part, but to raise another 300 million euros of equity. But once we get in touch and once we get in front and once we have the chance to show and to explain, then there is appetite, and that's what we saw in the equity raise that was so heavily oversubscribed. So again, it's not a walk in the park, but at the same time, there are definitely opportunities here for companies like us to attract additional capital to our region.
Mark, can I just make one follow-up point? Just following on for that point. As an investor, of course, we need to look for research, information, and you go on the likes of CBRE or their websites, you see a whole ton of research on Western Europe, but it can be difficult to find good quality research on the region. So that's one thing I would like to see more of. I know CTP put out some thought pieces on the region. I saw a recent article from Savills on Poland, which was very good. So I think trying to get more research out there, to Rutger's point, I think it would just increase knowledge, increase understanding of the region.
100%.
Dennis, you want to add anything?
Yeah, and sorry, just two words, please.
Yeah.
Sorry, and I can completely echo what Dennis, what Rudiger is saying. When we had a capital markets day last year in Bucharest, and then we took them to Belgrade, to Oradea, and to Timișoara, and people are just going, "Oh wow, I never realized it was like that," because none of the people who were on that tour, and we had 50 people, had ever been to all of those cities except the CTP guys. Yeah, and there is a level of ignorance, lack of understanding, about what is really happening. It's like, everyone thinks, Central Europe is, yes, 30 years ago, completely dependent on foreign capital. Now, last year was the first year in 5 where there was more foreign capital invested in the Czech Republic in real estate than domestic. Actually, domestic capital is taking over because domestic capital says, it's on my doorstep, and I can earn 200, 300 basis points more than I earn if I go to the West. It doesn't make any sense. Yeah. So the smart money is staying at home and saying, okay, I want to play here.
Let me
Dennis?
maybe give you
Sorry.
another example of lack of understanding or education from our business, and that's so simple to explain. When you are in old Europe, as we say now, Western Europe, you have high street and you have shopping centers and retail parks and whatever in our industry. When you are in Central Eastern Europe, and there are maybe a few very exceptions, like in Prague, the Pariška or so, but there is no high street. So historically, because of simply the fact of that communism didn't allow for it, I mean, there are no real high streets, which means if you ever want to go shopping in these regions, the only place more or less you go to are shopping centers and retail parks. And that's what you need to understand. So the whole environment of competition within our industry, within the region, is completely different than it is in Western Europe. And most people don't even, they don't even realize that. So it's just, go there, look and see, and talk to people who know about it, and don't focus too much on indices and on this. And research, yes, you're completely right. I think we need to do more on that side. But in principle, yeah, you should make yourself a bit more knowledgeable as an investor on Central Eastern Europe if you want to participate actually in the growth that this region will show over the next coming years.
Yeah, I agree with both what the guys are saying, Richard and Rudiger. That's investors probably don't have much of an appreciation of the fundamentals, the real estate fundamentals that fall from strong macro fundamentals and strong growth. And that is, for example, all these Central Eastern European countries and SCE countries started with government debt to GDP ratios that are very low. That allowed, for example, for outsized increases in minimum wage levels that spilled into, also very large increases in state employee wages from, let's say, 2015 to 2024. Without really having looked at any figures, I would have thought that in Romania, for example, the average salary probably quadrupled, right? Which by far, in real terms, outperformed Western Europe. And that's a spillover in what Rudiger is enjoying now, and very good turnover volumes of his retailers in the shopping centers. So that you would not have had in the US. Now in the US and the UK and Western countries, you also have massive existing stock. So once the digital shopping became more of a thing, then the effect on shopping centers in the US, for example, the UK and the Anglo markets was much more outsized than it would have been in Central Eastern Europe and SCE, where the stock only started being built in the mid 2000s, right? So again, it's, I think, what the guys are saying, further education of pushing the fundamentals and explaining why macro or positive macro and strong growth prospects translate into strong real estate fundamentals in most sectors.
I think I know the answer before I ask the following question. I know it's going to be different for each company. But there's something new to me. I thought, having been in this business for as long as I have, I'd seen just about all the big companies and portfolios, public or private, in the region. But maybe it's just me being thick, but I just came across this company, Accolade, private fund, actually, that has almost, I think, 1.8 billion euros of assets in Central and Eastern Europe in logistics and industrial and maybe some other. All that money seems to have been raised through private funds, institutional investors, and maybe retail too. I'm not really sure. I guess what I want to ask each of the corporates is, and I have a different question for you, Mike, but are there the structural issues that have been talked about in various forms with respect to the capital markets for Central and Eastern European property companies holding back your growth? Or are you able to grow at the pace you would like to grow, given the availability of internal resources and debt capital? And if so, are there other forms of equity, not through the public market, that might allow you to grow at the pace that you think you could grow? So maybe start with you, Richard, on that question.
Yeah, look, yeah, I mean, we also did a capital raise last year. First one since the IPO, was 6 times oversubscribed. No, so the demand is there. The capital would be there as and when you ask for it, if you have the right story. You know, and I leave it for Mike to comment on that. But I think, you know, NEPI prove, we prove, you know, the capital is there. You know, funding, we did 2.4 billion euros of funding in 2024 gross, and we bought back and prepaid a billion as well. So net was 1.4. You know, so the money is there for the right story. You know, so it's do you have a business where you have growth? Do you have a business where you have growing cash flows? Do you have a business where you have stable cash flows? Because our business is definitely located in the fastest growing economy, also with the lowest tax rate. So you have way faster growing disposable incomes. Yeah. So what supports Rudiger and his business is fast growing consumption. Consumption in Central Europe grows more than twice the rate of Western Europe. Not surprising, economies grow twice as fast. Yeah, that is positively beneficial for our business, because what if retail's growing and demand for logistics space is growing, it's also beneficial for the other guy's business. You know, so overall, yeah, you know, the capital is there if you have the right story.
Yeah, I would. Well, we've both been proving this. It's more about, as well, at the same time, what kind of story. So meaning, we need to have, of course, opportunities in the market. It doesn't make sense to raise anything that costs you money if you can't deploy it into something that makes money. So that's, of course, let's say, something where I would say that could become more of an issue, because what we see, at least in the markets now, that our yields are start to compress. There is more money coming into the market. There's more interest into the market. That also makes the market more expensive. That's something we need to, let's say, observe closely. But to raise the capital as such, if you make the effort, yeah, doable and have the right story, I would say the same thing. What has helped us, of course, is the fact that interest rates came down. And if this would be a further trend, I think this would also support our business. So these two things, we need to see what kind of opportunities we have in the future in the market. And on the other side, of course, what are the costs of funding?
In the interest of the time we have left, we wanted to leave some space open for Q&A from the audience. There's a couple here that have come in. Let me just go to the first one. It's directed to you, Mike. I think One United Properties is a recent EPRA member, listed in Bucharest, mostly residential. I think mostly development. I don't know if there's a rental component to the business. And the CFO of One United, Cosmin, has sent in a question for you, Mike, about, I think, fundamentally, what is it you're most looking for out of a Central Eastern European story? I would maybe add to that. They're listed in Bucharest. Would it change your attitude towards the stock, assuming you like the fundamentals and the backdrop and the rest of it, if it was listed in old Europe on Euronext or London? Would that change anything for you?
No, I don't think the location of the listing necessarily matters. I mean, for us, it's the demand supply. I think that's what it really comes down to, right? I mean, if we're talking property, that's what it really comes down to. And I mean, I was thinking about this kind of sector outlook earlier. You know, for me, residential is probably kind of one looks to be one of the best in the region. I mean, just from doing some research on Poland, fundamentals looks very strong. So for me, you know, it comes down to simple things: demand, supply, and I certainly think residential looks to be, you know, one of the best.
David, haven't heard from you in a while. There's next question here. I'm going to aim in your direction. of all the sectors and all the countries that you're active in, because you see across the piece more than anyone else here, where's the what are the hot spots? What do you see as the most attractive in your portfolio?
Look, I think some of this has been touched on already, but if you had to choose the jewel of our portfolio right now, I'd probably say retail parks. I think retail park performance has been spectacular across the region. We have close to 100% occupancy in our retail parks. We benefit from a lot of the themes that Rudy went through earlier in terms of the lack of density of real estate around the region, the fact that, modern retail has only been built for the last 20 years around CEE. We benefit from all of those things as well. So we're really happy with the retail parks. We continue to see really good opportunities in Poland. I think that the factor we didn't talk about was, what could possible resolution of the war in Ukraine mean for appetite to invest in CEE? I would say from a company that mostly uses the bond market, we could see very clearly a shift away from CEE risk after the invasion of Ukraine, and maybe a resolution around that would actually help overall. But I would say, we think Poland has lots of really good long-term opportunities. A lot of people are writing about residential to rent is the one sector that is kind of hot and everyone sees the opportunity there. We're mostly invested in office in Poland, but our outlook is good. We have parts of our portfolio that are not performing as well. Berlin has been a tougher market. I wouldn't call it CEE, maybe more Central Europe. Budapest has its challenges, but overall, I think we feel good about the performance. Again, I think in our portfolio, it's always going to be a little different listening to some of these others speak, because the opportunities that are available to logistics at the moment, that's been the flavor of the last decade in terms of investors really being interested in logistics, and certainly retail has been turning around very nicely. We do have some challenges in the office sector, but I think the diversified nature of our portfolio continues to work very well.
Another question. I'm going to try to spin this towards you, Dennis, somehow. It's a question specifically about the political situation in Romania and what it might mean for investor attitudes and I guess investment fundamentals. But I'm going to add a little bit of spin to that, and I'm going to keep my eye on Richard in particular as I ask the question, because I don't see in these type of panels people asking questions. I remember back, December 2022, when there were 1 million protesters on the streets of Spain and Madrid for judicial reform. I don't remember a lot of people asking questions about political risk in Spain as it mattered to REITs. So is it unfair to ask questions like this about political risk in Romania when people are not asking these questions? And remember, in Belgium, they were without a government for 560 days, and I don't think that was a major topic at REIT conferences, at least as I recall back in those days. So Dennis, how do you react to the question on political risk in Romania?
Yeah, I would have thought that the fundamentals of Romania would be overshadowing any short to medium political risk. As Poland is the rest of CEE, will be enjoying strong GDP growth rates. Obviously, on the back of, even if fiscal policy was much more expansionary and the government has the headroom to do so, I would not see that, even if there was a more extremist type of president, let's say, being elected, would institute policy that is, very damaging to the economy, and would go against, the fundamentals, the positive fundamentals that Romania has from a macro perspective. Also, as I said before, from a supply perspective, where supply is quite restricted, and it's of course helpful for existing portfolio owners. So again, overall, I would have been more concerned about the risk aversion of international investors on the back of geopolitical risk, rather than the war in Ukraine, which we would have thought, as David said, it has to be a resolution of it at some point, and probably the Trump administration will be an impetus to getting there. So again, I don't think that political risk related to the uncertainty that's come from the presidential election would be really significant.
Anyone else want to make a final comment on that?
So is it unfair? Yeah, but life is not always fair. Yeah, you know, we're just gonna get an extraordinarily volatile personality as president of the US again. Anyone worrying about political risk in the US?
And people are happy.
Yeah, you know, look, you know, politics is never a stable scenario unless you're in China or North Korea or something like that. You know, and the point of a democracy is, yeah, you can have one or the other change. You know, just I think we're going to see some interesting developments in Germany and France this year in the next elections. If I look at the way the elections are going to go, and the next one likely in the UK is going to go, whoa, then I think then you can start talking about political risk. Yeah, you know, so I think, you know, people focus on headlines because everyone is focused on the short term, and I want to sound as though I know what everything's, you know, in real estate, it's a long-term business. Yeah, you know, and what is really important is what factual, actual, real changes can these people make. Most of the time, what politicians can really change and what politicians do really change is materially overestimated. They actually say a lot and they do a hell of a lot less. You know, you had a radical government in Poland for 5 years, having a fight with the EU. Actually, growth didn't really change during that period or with the new government. So I think sometimes, you know, those things, you know, can be a bit overestimated.
So maybe to wrap up, again, David, with a nod to you, going around the horn one more time, David, and starting with you. If you had to pick one Central European country and property sector that you were not in, that you would wish you were in, can you tell us what that would be? And I'm going to go around to everyone. Residential development in Bucharest, for example, where One United is positioned, or what do you think?
I mean, the reality is I'm supposed to say the following message, which is we're absolutely in love with every place that we are invested. And, you know, again, you've heard my pitch on Poland. I think at the end of the day, there are many sectors that I think are going to continue evolving in Europe, things like data centers, student housing, all the things that are really sort of, if you ask all the equity analysts what the trendy sectors are, you know, all of us, you know, are kind of invested, I'd say, maybe with the exception of logistics, in sort of more, you know, diversified office, retail, things that are more old school. Some of these new sectors, I think, are really exciting, but, you know, not for us at this moment in time. We're sticking with what we've got.
Rudiger, over to you. Data centers, if you could, would you?
No, I think that's a very interesting new asset class, actually, that is, I mean, it's getting so much traction. If you look at investments, let's say, of companies like Blackstone currently in the US, and I think this is a trend, not only a trend, I mean, this is a necessity and it will be a commodity. And I think that is interesting. That is definitely, let's say, an asset class I would look into, especially in Central Eastern Europe, because of different reasons. But I think Central Eastern Europe could be a really good add-on to the existing market. So data centers would be definitely something to look at.
I'm going to come back to you at the end, Mike, but first, Dennis, you next, and then Richard.
Yeah, I would think that sectors with more idiosyncratic characteristics that reflect these long-term trends of digitization, as Rudiger said, DCs, and urbanization. So, you know, resi for rent, social housing, PBSA. Okay, mind you, I'm only doing office, right? So this is everything we haven't done. And of course, the other major trend would be aging populations. We have, you know, senior housing, retirement, and on top of this, you know, you also have all the traditional sectors, which would be much more GDP and macro correlated. So I think you get this double whammy if you're looking at these non-traditional sectors.
Richard, your turn.
If number one is obviously logistics, but no. But it's in terms of other sectors, I think in terms of relative value for the next 12 to 24 months, probably office, because everyone underestimates how much work is still actually done in offices. So I wouldn't be as, chronically negative on offices as lots of other people. A year ago, I would probably have said retail because it was, but that picked up a lot now. So if you want to return in the next 12 to 18 months, probably offices, because that's the one that's underestimated.
And so, Mike, I'm gonna reframe the question for you. If you could design a Central European property company that was in the countries and the sectors that you could plow your substantial $92 billion worth of assets under management into, what would that look like?
Well, maybe I'll reframe the question just a little bit more to what I'm allowed to say. I think for me, the market outlook probably still looks the best in resi and logistics, relatively speaking. So I would probably say those two sectors. Country-wise, I'll probably go to the corporates in the call. I mean, they're better placed to talk about the countries, but sector level, market outlook for me looks best in logistics and resi for next year.
Okay. Well, I've got my eye on the clock here. We're a little bit over the hour. I don't know, Barney, if you say we've used up all our time.
Yeah, I think that's good, Mark. I think we can wrap here. Thanks very much, everybody. Great webinar. Thanks.
Thanks, everybody.
Thanks, everyone.
Thanks, everyone. Have a good day.
Thank you. Bye-bye.
Bye-bye.